So, good morning, everyone, and welcome to the third webinar in our series about inheritance tax and family investment companies. For those of you who joined us the last time, you will recall that this is a topic which has become increasingly important for families who are wanting to preserve their wealth and pass it down to future generations. Today, I am really pleased to be joined by my colleague Lucy Crowe, who advises on the set-up and tax implications of family investment companies. I'm also delighted to introduce Andrew Gilbert and Andrew Hannay from Quilter Cheviot. Both are experienced wealth managers who specialise in advising high net worth individuals and families on long-term investment strategies and corporate structures. So today should be a great opportunity to hear from Lucy about the tax aspects of setting up a family investment company, and from both Andrews about the investment management services which can be provided by Quilter Cheviot to complement this. There will be time at the end to ask any questions. So please, as we go through the presentations, if you can pop any questions into the chat box. So I would now like to hand you over to Lucy Crowe.
Thank you very much, Dawn. This morning, as Dawn mentioned, we're going to take you through family investment companies. So our agenda, we're going to start with what our approach at Henderson Logie is to that initial planning stage with a FIC. We're then going to go through a case study, looking at a case study with 5 million of investment. And I'm then going to hand over to Andrew and Andrew to look at investing those funds, what their approach is to the investing, and also looking at that same case study with 5 million. As part of that, they'll show you what kind of income would come off that. And then I will take over again to talk through the remuneration, how that income can be passed out to the various family members. And then we'll finish up on the formal part of the presentation, looking at how the wealth can be passed down the generations, and then Dawn will lead us through a question and answer session. So as Dawn said, do put all your questions into the chat box. So at Henderson Logie, where do we start with a family investment company? We always start with an initial meeting. So we want to actually meet the clients face to face, ideally, and sit and discuss the family. Who are the family that would be involved? What are the assets? And what's their overall inheritance tax position? We very often get people coming in asking for a family investment company where actually it might not be the most appropriate planning for them, or other people who've perhaps come in looking at other options. We can then suggest that actually a family investment company might be. So it's important to start there and see whether it is going to be the right suggestion. Once we know that, then we want to understand what the main objectives are from the family investment company. What are the family requirements for income? Who needs capital? What's the longer term thoughts? And are there also issues within the family? Perhaps all of the wealth is with the top generation and they would like to maintain a level of control over that. As it passes down the generations, perhaps there are concerns over future changes in the family, divorces. All of these things can get factored in at that initial planning stage. And then we would take all of that along with knowing how much they want to put into the family investment company. And we would prepare a report setting out how we suggest that it's structured to make sure that it does suit the family and achieve all of their objectives. After we've sent out that report, there's normally another meeting, not always, but normally another meeting just to tweak that and make sure it's absolutely spot on. And then we would start speaking to solicitors to arrange to actually get the company set up. So they would do the setup of the company, arrange the share structure in line with what's been proposed, prepare the bespoke articles of association, which we've talked about in previous webinars as being one of the key things. The share structure and the articles are what make a FIC rather than just a normal company. And we'd also always recommend a shareholders agreement and sometimes additional pieces of paperwork and legal documents around that. Once all of the legal work is done, we'd then look to finalise the company and actually transfer the assets in. And once that's in, it's then really important to look at how the company is going to be run, how the funds are going to be invested, and I'll obviously hand over to Andrew and Andrew later on to talk more about that, what record keeping is needed, and the operation, who the directors are going to be for all the day-to-day planning. So if we now look at this in practice, so let's look at a case study to make this come alive a bit more and not just be theoretical. So the case study we've picked is with an investment of 5 million. On speaking to Andrew and Andrew a lot and preparing for today, between us we've got FICs ranging from as little as £500,000 right up to well over 50 million. So you can do a FIC with any amount of money, but probably the most typical we see is around that 5 million mark. So we wanted to use that as a good example today. So the family that we've chosen, there are grandparents, parents, and the children. And the funds, this 5 million has come from the sale of a business. So the mother and grandmother were in business together, sold their business a few years ago, and it netted them £5 million. And currently that is held in cash and not really doing them very much. And it's held equally between the mother and the grandmother. So that's 2.5 million each sitting in their estates for inheritance tax. So not desperately tax efficient, either from an investment point of view or from a tax point of view. And in this family, they do want to preserve the wealth and pass it down the generation. They want to maintain an element of control so that, certainly the young children, school-aged children aren't having huge amounts of control here. They obviously want to minimise the inheritance tax and capital gains tax as much as possible. But the other things that came into this are, for the grandparents, they're concerned about future care cost needs, if they're needing a care home in the near future. For the parents, they've got a large mortgage, large expenditure, including school fees for the kids. So those were some of the things to factor into the planning. The proposed structure in this example would be the fairly standard one of a private limited company with bespoke articles of association. I have seen a FIC recently that was set up as an unlimited company, but generally a private limited company. And the most important point is those bespoke articles of association that very clearly set out what can happen in the company and what, more importantly, often what can't. We then look at the share classes. So in this particular example, we've gone for alphabet shares, again, fairly typical for a FIC. We've got A shares going to the grandparents. They're pretty happy that their needs will always be pretty much the same. We've then gone for B shares to the father, C shares to the mother, because they might want different levels of income year on year, and D shares that are going to go to the grandparents, but then be settled by the grandparents in trust for the grandchildren. And that initial £5 million is going to be injected. Well, there's a number of ways you can inject that in return for shares, in return for a director's loan account, or as an outright gift. We're going to look at the share subscription and a director's loan account today. And the other thing I would say is, very often before you transfer the money in, especially in the example we've got today, you would want the money transferred between the spouses so that it's all four of the grandparents and the parents that are putting the money into the company, because that's going to give us a little bit more flexibility. So lots of numbers on here, but essentially it was just to illustrate what this might look like when we put the money into the company. So the grandparents are putting in 2.5 million. They've put in 500,000 of that as a director's loan account. So that's 250,000 each. They've then taken out 2.3 million A shares and 1 million D shares. Now, because of the directors' loans, those shares, there's going to be, as you can see from the table at the bottom, 5 million shares, but the shares will not be worth exactly 5 million because there is a directors' loan account. So the company owes money to the directors, and therefore actually the company is only worth 3 million. So our 2.3 million of shares are valued at 1.4 million, and our 1 million of shares are valued at 600,000. The important point with the D shares there is that 600,000 is within the nil rate band for the two grandparents, so 325,000 each would give them up to 650,000 that they could put into trust within their nil rate bands and not incur an inheritance tax charge. So those D shares will be immediately put into trust for the grandkids. And then we've got the parents, so they're going to put in, again, 2.5 million in total. So that's 750,000 each into a director's loan. So that's giving them a much bigger pot they can draw down on. And then 833,000 shares each, and that'll be valued at 500,000. So that is our case study FIC set up. And I'll now hand you over to Andrew and Andrew to talk about how you would invest.
Good morning, everyone. Thank you very much, Lucy. Good morning. My name is Andrew Hannay, and I am an investment manager with Quilter Cheviot based in the Edinburgh office. I work alongside Andrew Gilbert, who will shortly introduce himself. But I wanted to spend a little bit of time today running through why we believe Quilter Cheviot should be your natural choice of investment manager in relation to family investment companies. Now, as a business, we have extensive relationships with corporate professionals such as Lucy and Henderson Logie, where we work collaboratively to enhance and achieve client outcomes. As a company, we are also very highly experienced and manage just over 2.4 billion in corporate assets, covering, for example, the likes of family investment companies and private family works, ranging in size from as little as 1.5 million up to 50 million plus. We also have access, which is one of our real strong points in the market, is that we have access to one of the largest UK research teams with a robust process and risk discipline. And as a consequence of this, our historic long-term performance is very, very good. And as such, we have a clear track record in managing diverse family investment company portfolios. More importantly, with working on a collaborative basis, we can create bespoke portfolios with extensive direct equities to facilitate the use of franked dividends. And we'll cover this in a little bit more detail shortly. We are also dedicated and experienced investment managers, and on the basis of this are able to provide exceptional ongoing service to both to individual clients and family investment companies. But we'll cover this in a little bit further detail in due course. In terms of my background, I have over 25 years experience in the wealth management industry. I'm a holder of the Associate Society of Investment Professionals, and I'm a member of the Chartered Financial Analysts UK Society. I'm also a chartered wealth manager and also a chartered member of the Chartered Institute for Securities and Investment. I have extensive experience over the years with dealing with high net worth clients, corporates, and especially family investment companies. Before I hand you over to my colleague, Andrew Gilbert, I have worked with Andrew for a number of years, and our skill sets certainly complement each other in terms of the underlying management of family investment companies. But I'd like to pass you over now to Andrew.
Thank you, Andrew. It's an absolute delight to join you this morning. Thank you for your time. So just to touch on my background, as Andrew mentioned, we worked together for about 3.5 years. My background is very much on the research side. I've got 15 years in investments, worked as an senior investment manager at Parmenion for about 11 years, have a degree in economics, so I like to understand how things work, CFA charter for my sins, and received an awful lot of awards At home, I've got 4 kids and lots of pets and dogs, so hopefully that makes it easy to relate to, and I'd love to have a chance to meet you. So the next slide is really looking at the power of compound growth. Lucy mentioned that we come across a lot of families that have a lot of their assets sat in cash. And I think one of the things that a lot of people miss is that even if you leave those, if you get interest on that cash, often it's at the same rate or only marginally above inflation. So this chart shows you since 1900, if you put £1 of cash and left it in an interest earning bank account, after 125 years, which is quite a long time for you and I, it would be worth £2 after inflation. So 125 years of interest gets you very little after inflation. If you put that into a bond, then it would be worth £3 after inflation after 125 years. And if you put that into a global equity market portfolio after 125 years, that'd be worth £419. So you can see that the way that you compound capital over the long term above inflation is by investing in the global equity market. And that's why it's so important, not just to get that tax efficiency point right in the first place, but also to get the assets properly invested, is because that's your long-term source of compound growth. So just taking Lucy's example of an average kind of 5 million client, we thought it'd be helpful is to show you in a bit more detail what we'd do with those assets. So we have a kind of long-term picture and we have a short-term picture. The long-term is obviously that we want to provide growth above inflation. And the primary vehicle that we'd use to achieve that is our growth portfolio, which has about 80% in equities, as we'll show you in a second. So we'd put about 4.5 million into our growth portfolio. That would be bespoke, completely designed around the family's needs and their requirements. It would be invested almost entirely in direct securities. So you're thinking direct bonds, direct UK, US, European companies, names that you would be very familiar with. And that would be diversified across a broad range of securities to make sure it's properly diversified. Obviously, there's a range of shocks that happen from a macro perspective, like Trump, for example, and tariffs, changes in currencies. There's also a lot of different themes across the industry, like AI and climate change. So you want to make sure your sector weightings are right, as well as your asset allocation, your geographic spread. Then we want to make sure that we've got a sufficient range of companies that we're actually investing in. And this is where we really lean into the 40,000 hours of research that our analysts do every year to try and find those kind of best 80 to 85 underlying holdings that we can find globally. So that growth portfolio gives us an expected return of about 7% over the next kind of 7 years or so. And that's made up of about 5% capital growth and 2% income. And that breakdown is quite important, as Lucy we'll talk about later, because the income in particular, if you invest it in direct equities, has already been franked. You've already paid tax on those dividends. And so that can be considered as kind of tax-free income, essentially. And then the other aspect is that we have to appreciate the markets are volatile. Equity markets are fantastic over a long period of time, but there are certain periods like the financial crisis and during COVID where markets can sell off quite aggressively. And during those periods, the family will still want access to capital, essentially. But what you don't want to be doing is selling down equities to make those payments after a big equity market shock. And that's why we have a short-term bond portfolio as a source of liquidity, essentially. So that gives you a rate of return of about 4%, which is above the vast majority of cash savings accounts. It's minimal risk. It's only invested for 0.7 years in government bond type securities. But if there's a market shock, then we can shift the withdrawals within the fixed structure so that more of the withdrawals come from the short-term bond part. And then that gives us time for the equities to recover in value before you can trim those. And we just have this, and because we have so many meetings on an ongoing basis, we can constantly reassess this depending on how markets are doing and change where the assets are coming from, depending on what happens in markets overall. So we also wanted to give you a bit more color on what a growth portfolio would look like. So with our example 4.5 million portfolio, you can see about 8.5% of it would be going into bonds. They would be very high credit quality bonds, like government bonds, investment grade bonds. So you're looking about 382,000 into those types of securities that are giving you a decent income, but primarily are there as a source of capital protection. Obviously, during periods of market shock, you do get a flight to safety. and those bonds can give you a decent source of income, but are primarily their capital values will rise if there is a big economic shock globally. But most of your growth, as you can see, is coming from your equities. That's 3.6 million of your assets are going into those securities, which are then diversified across a broad variety of different regions, UK, US, Europe being the primary areas. In terms of our individual weightings, that will be determined by Andrew and myself, but also with feedback from our underlying analysts and the wider investment company. So, for example, at the moment, we're running kind of overweight UK and European equity positions, overweight Japan, Asia, and emerging markets, and we're kind of slightly neutral, or even slightly underweight US at the moment because of concerns about Trump, about concerns about the dollar and the sustainability of earnings, essentially. So you can see that we are making tactical calls on an asset allocation basis, depending on where we feel the best opportunities are. What we thought would also be helpful is just to show you where the income is coming from. So you can see about 46,000 of that income is coming from direct equity investments in UK, US, and Europe, all very much developed securities. And there we can prove that those dividends have already been franked. They've already paid tax, essentially, and therefore that can be your source of tax-free income in the future. So if we add all of that up, a 5% capital growth on 200 on the 4.5 million and the 4% return on the short-term bond, you get 245,000 a year on average from growth, essentially, of the capital values of the FIC. And that's obviously a lot more than you would get from just cash, essentially sitting in the company, as we've shown to you before. And then you can add to that the extra income, which is about 88,000, as you can see in this example, which gives you a total annualized growth figure of about 6.7%, which is about 333,000 per annum. So hopefully that all makes sense and you can see where that's all come from. So we just wanted to mention some of the kind of top points that we see time and time again of how we can really kind of add value. As you will all be no doubt aware, there is an awful lot of market volatility around at the moment. Trump has announced a lot of tariffs and he keeps changing his mind about when they will take place, how much they will be, and what exclusions there are. There are a lot of new trade agreements that are constantly being put in place. And that is creating a lot of market volatility. Companies are finding it very difficult to know what their future investment plans are because they're finding it hard to know what their cost of capital will be or the cost of the supply chain. And that necessitates a lot of research, the 40,000 hours of research that we put in to make sure that your portfolio is invested in the best places that it should be invested in, and we're minimizing risk as much as possible. Also, family investment companies are complex arrangements with very different client requirements, as Lucy mentioned. And so you need to have experienced investment managers who really know what they're doing and have a very open dialogue with Lucy to understand what those client requirements are, and then the ability to create a bespoke portfolio around those requirements. Also, as I mentioned, you want to have a high equity weighting. Typically, family investment companies, investors and beneficiaries will have a very long-term investment horizon, and that generally leads itself to having a higher equity weighting as a result. Also, obviously, as we mentioned before, your higher equity weighting gives you a higher total return. It gives you more income that's already been franked, and it also allows you more control of your tax, because then taxation is at the point of sale on the majority of your assets. In terms of the fixed income securities within the FIC, we have come across quite a few times a misunderstanding on how these assets are treated from a tax perspective. And given our experience in this area, we're very familiar with the loan relationship legislation that applies to these securities. That means that we can give accurate tax reports to the accountants and anyone else that's involved in running the FIC to make sure that your tax is correctly calculated. We have had experience with other FIC clients that we've inherited where this has been managed very poorly in the past and has led to a lot of complications and misunderstanding, which we'd rather you avoid for obvious reasons. And then in terms of professional management, obviously, hopefully I've tried to show you how it can really help you to have it properly invested and professionally managed by everyone, not just ourselves, but by Lucy and Henson Logie in general. But obviously, it's important to note that a lot of these kind of professional management fees are tax deductible, and that means that we've got a source of we can change the portfolio on an ongoing basis depending on what happens in markets, essentially. using that tax deductible allowance that we already have in place within the FIC vehicle. And then, as I mentioned before, obviously a FIC will need a source of ongoing liquidity. If markets are going up nicely by 7% per annum, then we can just run it from the long-term vehicle and a small amount from the short-term bond. But unfortunately, markets don't behave in a straight line. It won't be 7% every year. Some years it will be up 20, some years it will be down 10. And so you do need that source of protection within the FIC structure, where you can take withdrawals from that short-term bond over a short-term period, essentially, to avoid you having to sell equities after they've dropped in value. Because obviously equities typically do recover in value, but if you sell the shares, then they won't get back to the same level they were at before, essentially. So that short-term bond structure is absolutely essential to manage that liquidity needed. I'm just going to hand you back over now to Andrew Hannay, who's going to talk through some of our historic returns.
Great. Thank you very much, Andrew. What I wanted just to focus on was Andrew talked earlier about the sort of asset allocation of our typical family investment company portfolio. And I thought it'd be useful, therefore, to give you an idea of how well has performance done over the last sort of 10 years. And the slide in front of you shows performance relative to our peer group over the last 10 years. And the key sort of takeaways from this is that you will see that we have outperformed our peer group as measured by ARC in 6 out of the last 10 years and the current year to date. Now, Asset Risk Consultant are an independent investment consultancy based in the UK, and they collect performance data from the likes of Quilter Cheviot and all our sort of major competitors. So they collect on a monthly basis anonymized performance information relating to around about 100 investment companies in the UK. So this really gives you a good indication of, over the longer term, our sort of consistency of returns. And I think it's very important, to certainly highlight, over the last 10 years, being able to significantly outperform our peer group. The next slide, I think, is very, very important, and this puts into context as well, not only, as I mentioned earlier, consistency of returns over the longer term, but what I think is very important as well is to show you that across all our different investment strategies, whether it's a growth strategy, or indeed a balanced strategy, or indeed income, we have outperformed our peer group on a consistent basis over 10 years, 5 years, and 3 years. And more importantly, if we were to focus on the performance specific to the likes of a family investment company, you will see that over 10 years, we're up nearly 4.5%. We're up just over 4.5% relative to our peer group. Over 5 years, the figure is just over 2%. Over 3 years, it's 3.58%. And year to date, we're up just under 1%, again, reflecting our consistency of approach and risk and managing risk quite carefully on that basis as well. Lucy, the underlying work that goes into various multiple meetings and developing and creating a better understanding of requirements for a family investment company. We work very closely, to help them tailor a bespoke portfolio built specifically for the family and their individual circumstances. And this, as you would imagine, involves regular ongoing meetings, again, to take into account any evolving circumstances, and also make sure that the underlying portfolio is working in the best interests of the family investment company. We also provide quarterly reporting, which tends to be valuations and market commentary typically, but we also are able to provide any bespoke information required by the underlying family investment company portfolio and indeed the advisors. At Quilter Cheviot as well, we provide online access on a 24/7 basis, which can be accessed through either our client portal or indeed, as we do for a lot of clients, through a mobile app. As one would expect, we also provide dedicated points of contact in our day-to-day management of family investment companies. And we typically have 2 experienced dedicated investment managers, such as Andrew and myself, who who always make sure we never kind of away on holiday at the same time. So there's this consistency of making sure, you know, portfolios are monitored carefully, and we can respond as such to any requests as well on a very short-term basis. As part of our dedicated long-term service, we're very pleased to announce that we're able to deliver very good client satisfaction rates, which are done on a quarterly basis, typically are above 90%. Again, you know, showing that we really listen to the needs of our clients and indeed manage portfolios extremely well. As Andrew talked about earlier, we also as well are able to provide detailed tax reports for the underlying family investment company portfolio, and indeed to the advisors as well. But most importantly, as an investment house, Quilter Cheviot are very aware of the nuances of tax reporting, and indeed, you know, do take into account the likes of loan loss relationships, which a lot of our competitors, you know, to a large extent, have not been able to do so. And we've actually, one of our recent mandates we won in the last few months, actually highlighted this potential issue, which we managed to resolve. But I'll now pass over to Lucy, if I may. Thank you very much. Thank you.
And thank you very much there to both Andrew Hannay and Andrew Gilbert. What we're going to talk about next is remuneration. But before we get on to that, once you've got the company set up and you've got the investments, then you've actually got to run the company. So it is vital to work with people like the Andrews in having that fantastic reporting so that you can then do the accounts really well. The better the reporting that we receive, the quicker and the more efficiently and cheaper we can do the accounts for the family investment company and then the corporation tax. And having investment advisors who are taking that into account. So within the company, yes, if a lot of the income is coming from dividends, that very much keeps the corporation tax down in the company. So as you saw from their example of that £5 million that's been invested, we've got over 300,000 generated on an annual basis. So for a lot of family investment companies, actually, a lot of the income and the growth is retained within the company so that it's building and growing in value. But we just wanted to have a look, what if you did want to take all of that out in a year? And if we go back to our case study and think about the needs of this particular family. So at the moment, we've got the grandparents, and they've got, modest requirements at the moment. They're not in long-term care. In this particular example as well, we have set them up with a state pension of equal to the personal allowance, which never happens in practice, but to make the numbers nice and easy. So they've got 12,570 of a state pension, which uses up their personal allowance. So if we then take for them, so I'll just use a little pointer here. So we've got their director's loan, which they can extract tax-free. So they can take 30,000 each out there, and that's tax-free. And then their dividend, they've used their personal allowance, but they've got their dividend allowance, and then it's taxed at that 8.75% rate. So a very small tax liability there. They're getting just over £58,000 in their hand with just a tax liability on that of 1,706. So very tax efficient for the grandparents. And that's not eating hugely into that director's loan that they've got. But if, for example, one of them or both suddenly did need more long-term care, nursing home, something much more expensive, they've got that director's loan that they can draw down on. And then we look to the parents. So we've got the mother and the father. And if you remember back to the shares we set up for them, they've got the A and the B share. Sorry, they've got the B and the C shares. So they could take out different amounts. Just for the purposes of the example, we've given them the same amount for now, but it could be different. So we've got them taking 40,000 out of their director's loan, and then a further 20,000 out of their dividend. But for both the mother and the father in this example, they also have employment out with the family investment company. So they are higher rate taxpayers, and you can see that on that same £20,000 dividend, with them being higher rate taxpayers, that's a significantly higher tax bill for them. So they're taking 60,000 out, but actually ending up with 53. So, you know, the tax is very important in what you're taking out. And we've also got them here taking some funds from the company and putting it into a pension. That's typically been something we've seen a lot in family investment companies over the years. I suspect with the upcoming changes to pensions that come in from April 2027, that we will see less of that. But as we said before, pensions is probably a whole separate webinar. So watch this space. We will hopefully be back with something early in the new year on that. And then we look to the kids. So if the parents were paying for the school fees with additional dividend, you can see that would be a very high tax rate. But the children, I'm presuming, don't have other employment given that they're still at school. So they've got their personal allowances and those lower rates of tax and the dividend allowance. So if you took a dividend of £30,000 out on the D shares that the grandparents put into trust, it could go into the trust and then be distributed from the trust out for the benefit of the kids, could in fact be paid directly to the school, but it would utilise the children's personal allowance and basic rate bands, meaning of that 30,000, you've only got a tax liability of £338. So very tax efficient there. So in total, we've got 300,000 coming out of the company and just a tax liability on that of 17,250. So there are really tax efficient ways you can remunerate yourselves from a family investment company if it's been set up correctly. And to finish off, before we start getting into the questions today, the last bit is passing the wealth down the generations. So there are three main ways to do this. You can gift shares directly, you can transfer shares into trust, and you can also have shares with differing rights to growth and capital and voting rights. So when we started this, we set up alphabet shares for our particular family of A, B, C, and D. And what I should have mentioned at the beginning was for the purposes of this, we'd just done it based on them all having the same rights and to voting, to capital, to income. And that means that for that top generation, for the grandparents, within their estate after the planning, so they started with 2.5 million in their estate, after the planning, after putting those 1 million shares into trust, they've still got their £500,000 director's loan account in their estate and their shares, the 2.3 million shares. Those shares, as they draw out the director's loan account, will become more valuable. So they might want to look at actually divesting more of their shares down to the next generations. If they gift shares directly, so that would be a potentially exempt transfer for inheritance tax. We discussed that more in the last two webinars, so I'll not go into it too much today. But essentially, for a pet, if you live for 7 years, it's free from inheritance tax. If you don't, it'll be brought back into your estate for inheritance tax. So they could gift shares directly, either to the mother and father or down to the grandchildren directly, but not in trust, and that would be the pet, but it would be chargeable for capital gains tax. If they transferred the shares very shortly after setting up the company, before any director's loan accounts have been drawn out, before we've passed the investments over to Andrew and Andrew, or very early on, because you can see once it's been passed over to Andrew and Andrew, they are going to make all of those investments increase in value. So before there's an increase in value, they could transfer shares and there wouldn't be a capital gains tax charge because the shares wouldn't have changed in value from when they acquired them. So for the grandparents, they could look at doing that. fairly soon after the company's been set up for the direct transfers. However, if the company's been running for a little while, Andrew and Andrew have been investing wisely, it's increased in value, then if you were to pass on directly, there's likely to be a capital gains tax charge. That's when we'd probably look more to a trust. Now, for the grandparents, they transferred into trust already in this example, and that used 600,000 of their nil rate band, so they could use the other 50, 25,000 each. But 7 years after they'd set up that trust, that nil rate band would reset and allow them, based on the current rates, to do another 650,000 into trust. And that's always an option for the parents as well. The other option is to have shares with differing rights. So we could have perhaps set the grandparents up with shares that had voting rights and rights to income, but not rights to capital. Essentially meaning that the shares for the children and the grandchildren are essentially growth shares. So they're getting all of the growth in value, where the grandparents are not. So there's lots of things you can do there to pass the wealth down the generations and make these really as tax efficient as possible. So hopefully that was helpful today to go through a case study and see it in a bit more detail and how we would approach it, how Quilter Cheviot would approach it, and most importantly, how we can work together, because in doing the remuneration every year and passing the wealth down, it's important to constantly understand the changing needs of the family, understand the wealth behind it, and have really good reporting going back and forth between all of the advisors. So I will finish up. Again, very similar slide to the last two webinars, but it is the same final advice. Decide what planning is going to suit you and your family, and get good advice. So sit down with us, work out exactly what the needs are, what's going to be the best structure. Then we bring the solicitors in, we get all of that legal advice and all the right documents put around it. Then we execute the planning, get it set up, and that's working with an investment house like Quilter Cheviot, or if you're putting properties in, whatever it is that you're putting in, get all of that executed, get it set up and running really efficiently. Make sure you're revisiting that on an annual basis so that everything is remaining as efficient as possible. But also, once the planning's been executed, we would urge people to make sure you have another look at your wills. Something like setting up a family investment company can significantly change your overall estate, and look at insurance. And the final bit, before I pass over to Dawn for the question and answer, there is a budget coming up on the 26th of November this year. We don't know what changes will be in that, but I think there are likely to be further changes. So just be aware of that when you're looking at your planning, whether any of the planning should perhaps be executed prior to that date. And obviously we've got those big changes we've been talking about coming from April 2026 for inheritance tax around the business property and agricultural property relief, and then from April 27 on the pensions. So bear those dates in mind. And now I'll pass over to Dawn for any questions.
So I don't know if anybody has any questions they would like to ask. We don't have any questions in the box at the moment, so I will ask a couple of my own questions. So to the Andrews, I was just wondering, what trends are you seeing in how wealthy families are using family investment companies today versus potentially 5 to 10 years ago?
So we're seeing a lot of people very much interested in inheritance tax planning. I think the budget changes obviously put that into people's minds very much. And I think family investment companies in general are becoming more competitive, and so people are considering them at lower levels as well. But it's quite helpful to we've got some figures in terms of the general split, but about 30% of our assets are in the kind of 500,000 to 5 million mark for corporate investments. About 30% of our assets in the 5 million to 15, and then about 15 million plus. So there's a huge diverse range of different corporate client sizes that we look after with very, very different requirements. So there are some common trends like that. But as Lucy mentioned and Andrew mentioned before, at the actual underlying level, every family is different. Every family has their own very specific requirements. Just as you need to set up a family investment company with those specific needs, you also need to build your investment portfolio that's very carefully tailored to those needs and requirements as well. And then obviously from a market perspective, we've seen a big pickup in market volatility this year. We've all read the headlines, we've all seen the tariffs, and that means that not only do you need to get invested and out of cash, but we have also inherited FIC portfolios that have been running for many years and are invested in all the wrong areas. And that really highlights the benefit of getting it professionally managed, but also getting it professionally managed. So people that are very experienced with FICs and have a very deep research team that can really make sure that the family investment companies invest in the best assets that we can find globally.
And I think, as Lucy pointed out as well, it's about getting the foundations in place as well, and making sure that the FIC is set up where there's no issues and it's been done properly, so that it can be moved forward in the right way, and then we overlay them with the correct investment strategy. And I think that that is always very, very crucial in particularly with FICs. And there's a lot of issues that we see in the marketplace where it hasn't been done correctly. People think they can do it, but there's been a lot of errors. And I think it's an area which certainly the expertise of Henderson Logie makes such an impact, and I think that's very important.
Yeah, I would also add that we've also seen a huge crying out for service, essentially. So a huge number of people wanting more contact with professionals and with ourselves as investment managers to have a lot of conversations to understand their tax circumstances, but also their investments. And a lot of it's just reassurance as well, to make sure that it's being done the right way, essentially.
Yeah, I think that's really important. And I suppose, just as you were saying, in terms of investment strategies, be it conservative or growth orientated, I think what you're saying is that just really depends on the individuals.
Yeah, of course, we run portfolios across a broad range of different risk preferences. As Andrew highlighted in our ARC slides, we've got a wide range of different risk profiles, including short-term bond assets as well. So all of that is available to us depending on the specific client requirements. But obviously with a FIC client, you do have a family with a very long-term investment horizon. And they do obviously have a preference for higher growth, which often, as Lucy mentioned, you obviously put the growth often into the children, the grandchildren, same. And obviously you want to try and maximize income that's not taxed and minimize costs, and usually that ends up most family investment companies having a very high weighting towards equity. So you do tend to find most of them in those kind of growth orientated portfolios, essentially, which is why we thought it would be a good example to walk you through today.
Yeah, no, that's great. And just a question for Lucy. I don't know if you're able to give us a sort of indication of the upfront and ongoing costs involved in setting up and managing a FIC, really just from a sort of compliance perspective.
Yeah, I think the initial costs, I would say, for a meeting and the initial report, getting the right structure really nailed down. So probably 2 meetings, one either side of the report, and the report, it varies depending on the complexity, how many family members, what the level of investment is. Probably anywhere from about 5 to 12,000 would be our sort of average fee for those reports, depending on the complexity. Once you've got a FIC set up, very much the same compliant costs you'd have for running any company. You need the accounts done, the tax return, and then the individual tax returns for the individuals. So not a huge cost really, especially given the size of a lot of the FICs that we're seeing.
And obviously we're hearing about you obviously speak to your legal advisor, speak to your investment manager. In your experience, how long does it take from a client coming in to see you to sort of say, oh, I would really like to establish a family FIC, to actually getting it set up and operational?
I think the shortest turnaround we've had was just under 4 weeks from the client coming in to the solicitor setting it up and the investment advisors transferring the funds in. I would say that's not desperately kind to your advisors. Maybe give us about six to 8 weeks generally. Also, the more closely that your investment advisors, your tax advisors, and your legal advisors can work together, the better your structure is going to be, the better everything's going to run. So yeah, it's really important. It's why we really enjoy working with Andrew and Andrew. Really important that you get all of the advisors getting on. But yes, if you do want one very quickly, it absolutely can be done. But we might all go a bit grey-haired if everyone wants them turned around in three to 4 weeks. So
especially
6 to 8 would be the
with
average.
an up-and-coming budget.
Yes, absolutely. So 6 to 8 is probably the sort of realistic average we would advise clients when they come in.
And
obviously
probably
I will just say that is very much dependent on when the clients make decisions as well. So if we're sending everything out, clients are making decisions very quickly, and all the advisors are able to communicate. So yes, clients of course can take far longer to think about it, discuss with family, and that's absolutely fine as well. We have had ones, I think, that have taken over a year just because everyone wanted time to think and discuss and take their time.
And it's really important to do that, just to make sure you've got the right assets in your company. And probably just one for the Andrews. Would you recommend family investment companies as a sort of long-term structure, or would you see them more of a sort of medium solution to the sort of current economic and political climate?
Well, I think, Dawn, you pose a very interesting question, and I think that we certainly see, FICs as multi-generational. And I think the important thing is, as part of our investment strategy, we do take account of, the current, economic backdrop and how that impacts our, on current investing. But we certainly view, family investment companies as, long-term, and again, that's reflected with our particular, growth strategy. But we are, very aware of, sort of changes in the short term and how that might impact, what we're doing. But most importantly, that's why, we try and make sure, as with our fixes, as we have regular meetings with advisors and the underlying, family as well, to make sure that what we are doing is in their best interest. And, if we needed to make any changes short-term in terms of whether it's, increased income requirements or indeed, other changes, then we can implement those in a very timely manner.
Yeah, we've seen that come up time and time again. It's a long-term vehicle, but with a lot of ongoing interaction, both initially and on an ongoing basis, because family requirements do change, sometimes quite significantly. And it's very important that with that bespoke structure that's tailored to that family, that you recognise that those needs can change over time, and that you have that constant dialogue, as Lucy mentioned, between the professionals to make sure that everyone's got all the information and then we're all doing everything we can to enhance the outcomes for the family.
Great. So still no questions. If anybody wants to just put in a final question, please feel free. Just so one final question from me for Lucy. Lucy, you talked about the most common shareholding structure being alphabet shares. Do you see instances where individuals want to set up family investment companies with potentially different voting rights and different rights to income? And if you do, how would you go about working out what the best shareholding structure is?
Very interesting question, and probably the most interesting bit of setting up the company, and it probably goes back to that very first slide I started with, It's really understanding the needs of the family right from the start. I will say that you can change the share structure. So once the FIC's been set up, there's nothing to stop you then changing the share structure, adding in new shares, changing the rights that are associated with shares. So if the needs do change over the course of time, then, you know, we just call up the solicitors and get some tweaks made to that. But for the initial share structure, it will very much depend on what the family want. So alphabet shares with the same voting rights, rights to capital, rights to income, that's your sort of most straightforward setup, and the one that is the least likely to be in any way looked at by HMRC. But we do see plenty with growth shares, with voting shares only being held by the top generation or the upper generations. Those ones, as long as you get all the right paperwork around, as long as you've had a solicitor who's familiar with family investment companies doing all of the setup for that. Certainly the ones we've seen, we have not had any that have been challenged, but the advice out there is that they are more at risk of challenge, so it's really important to get the paperwork right. What I would say, though, is also there is a really important time for using growth shares with non-voting rights, but also it's the shareholders with the largest number of shares and the directors that make most of the decisions of a company. So if you've got people you're not wanting to be too involved in the decision making, if they're not directors, sometimes that or the use of a trust can achieve the same thing. So we look at all the different options and basically come up with the best one for the particular family that we're looking at the time.
That's great. Thank you very much. So I would like to thank Lucy and our guests from Quilter Cheviot for a very thought-provoking presentation. You will be sent the slides, so if you do have any questions, please do send us an email. And finally, thank you all for joining us this morning, and I hope you have a lovely rest of the day.
Thank you very much.
Thank you.
Thank you.